Well, the market is a bit wobbly right now, especially the Nasdaq. It's been dropping and some of the high-flying stocks are a little bit in a shaky ground right now. Let's talk about Nvidia, Tesla, and all the Magnificent Seven guys. There has been some profit taking going on right now. And when this kind of situation comes in, many of the new investors get shaky. They lose their conviction. They lose the belief in those companies, the technology and all those things. And what's required at this time, at this moment, is basically to revisit the fundamentals. And what would be the best place to start than the sage of Omaha, the greatest investor of our time, Warren Buffett. Hello everybody, and once again welcome to Sinhanomics. By now you have understood, today I'm going to talk about Warren Buffett. Yes, Warren Buffett is actually the universe of investment, is the world of investors. And if you are an investor or you want to be an investor or even trader for that matter, you need to know Warren Buffett, you need to know his principles. Having said that, it's a vast universe, guys. Knowing Warren Buffett and explaining them in 15, 20, half an hour video is impossible, because Warren has so many teachings for us, be it the life of general living, be it the life of investment, be it the psychology, be it philosophy, or be it charity, whatever. You can only learn from Warren Buffett. His principles, his mistakes, which he blatantly admits. That's the beauty of a great man. They actually admit their mistakes and teach the right lesson to the people who follow them. Well, I'm going to start a series on Warren Buffett. I'll call that Buffett's Nuggets. Yes, you got it right. These are Buffett's golden nuggets, guys. This will be time tested, it will be immortal. Whether Buffett is around or not, we are around or not, his principles, his teachings will be there for stock market to guide them throughout their investment journey. So what I have done, I will kind of break them into different segments. And today I'm going to talk about investing. You must have heard a lot about Warren Buffett, and if you are a serious investor, you must have read a lot of books and a lot of things about Warren Buffett, his annual report letters, his meetings, and all those kind of things. You are really well versed with that. So I'm not going to repeat those, though I'll use that as a basic principle, but I'll build my own story around that. And as I told you, the purpose of Sinhanomics is not about just giving you financial numbers, but tell you what actually investing is all about. And guys, trust me, investing is not just about knowing the company or knowing the finances or knowing the management. Otherwise, all the Harvard and Stanford graduates would have been billionaires by now. Do you agree? Put your comments in the comment section. So, investing is a holistic process that involves not only the finance education, it actually has a big say on the mental side, on the mental model. It actually talks about the temperament, how you react, how you take things, how you visualize things, what's your intuition. And that's all I'll talk about it today. And guys, if you really see my channel Sinhanomics, it's all evolving towards that. That's why I talk not about the stocks, I don't talk about the financial markets, I also talk about meditation, creative visualization, the importance of creating and developing intuition. All those kind of things come together to make you a real good investor. As I mentioned in my previous videos as well, NLP, neuro-linguistic programming, is, in simple terms, is a psychological process to analyze the strategies of the successful people and implement them, imply them for your success. In other words, it's about picking the brain. Yes, I also gave an example previously that if you are an investor, be it in the stocks, be it in the property, be it in the gold, and you want to go into crypto, for an example, and you are not very sure about it, what will you do? Number one, of course, you have to understand what crypto is all about. Then you should have the right conviction. You should have the right intuition that yes, this is the right investment for me. And if all of these are not going to help you, go with the NLP, neuro-linguistic programming. Use that methodology for the ideals you have, like the gurus you have. For an example, Warren Buffett. He's one of my gurus actually. He doesn't know that, but I'm a self-anointed disciple of him. Trust me. And this has built over a period of time. Sometimes I actually doubted his capabilities, his theories, and that was the dot-com boom. I was thinking, why is Warren not investing in this kind of, industrial revolution? And Warren used to say that I don't understand dot-com business. I don't understand technology. And that's why he did not invest. When the bubble burst, I realized the wisdom of Warren Buffett. Well, so if you are going to invest in crypto and you have no idea, despite getting some knowledge, etc., think about what these greats will do. What is the view of Warren Buffett, for an example, or Charlie Munger, for that example? Do you think he's going to invest in crypto? And if not, why? If you're not a gold investor, if you're not into gold or commodities, think about it. Why? Does it suit your style, your personality, your investment methodology? And if it suits, you're very convinced, you have a very strong conviction about it, go for it. If you have some doubts, go and use NLP, pick the brain of these great people like Warren Buffett, and see why he's not investing in gold, and you'll know the answer. So well guys, today I'm going to talk about the basic 7 principles of investing of Warren Buffett. And during elaboration, I'll a little bit give you some of my own thoughts. Well, let's start with that. The first thing Warren Buffett thinks and tells is the foundation of a company. And the foundation of a company is basically based on intelligence, initiative, and integrity. Yes, you heard that right. Intelligence, initiative, and integrity. And this can be in the employees, it can be in the promoters, it can be in the CEO or the senior management. If you're hiring somebody, these 3 things are very important to see, because knowledge the person will gain anyway. If he's intelligent, he'll get the knowledge. He's initiative, he'll learn a lot of other things. He'll involve and he'll drive a lot of programs. But most important thing is integrity. If the person doesn't have the integrity, he better don't have initiative and also intelligence, because an intelligent person with no integrity can be dangerous. And I have learned the lesson of integrity not only from my teachers and my parents, etc., but in the professional world, I have learned that in my company, where I have worked 24 years and still working. The management there have so much of belief in integrity that demonstrate that. I won't name the company, but I'll give you one example. The senior vice president and the executive vice presidents, many of them, they travel, and they used to travel in economy class. Guys, you heard that right. Economy class. because they think that if I am traveling, if everybody starts traveling in the economy, we are going to save a lot of money for the company. And guess what? If it's your own company, would you waste money? Think about it. These are the nuggets of integrity. The second thing, the most important thing, is pay attention to the facts and not emotions. Emotions are very important where it's important, like where you have to make decisions from your heart. In the matter of love, compassion, sympathy, empathy, emotions play a very vital role. But in investment decisions, investment is a killer. It's a going for investment decisions driven by emotion is actually financial suicide. Yes, you heard that right. You heard that right, guys. It's a financial suicide just to go for investment based on emotions. So go by the fact. Keep your eyes open. And my understanding is that, and I firmly believe in all the 7 principles I'm enumerating here from Warren Buffett, is that you need to understand. Know the fact means you need to understand the company, you need to understand the business. And then you need to analyze it based on the macroeconomics, based on the industry trends, based on the socioeconomic trends. And then you have to ask yourself, does it fit your style? Does it fit your personality? And if the answer is yes, and there are plenty of ways to do that, guys, I told you, it won't just drop from the sky. It won't come out of the blue, no. You have to do creative visualization, meditation, and you have to develop intuition. So what's your intuition telling about? What are the gut feelings for that? Think about that. And then if you think you're very convinced that yes, this is the investment for me, this is the stock for me, this is the business I'm going to buy, go for it. And remember, I always tell, nobody makes money on borrowed conviction. Yes, you heard that right again. No one makes money on borrowed conviction. You need to have your own conviction, your own style to make money. The third very important principle Warren Buffett talks about is buy wonderful businesses at a fair price and not fair businesses at a wonderful price. What does this mean? This means that before investing in the stock or before investing in the business, you should consider the price. Price is what you pay and value is what you get. If you look at stock market example for now, in US market, Tesla was trading at 315, 320 1 year back. And then this January 2023, it was trading at 110. Right now it was trading at 280, 290. And now it's trading at around 240. It's the same company, same Tesla. No fundamental changes are going to happen in the company. Nothing is going to change in the evolution of the electric vehicle. Everybody is there into that. They have the conviction. Everybody believes that the world is changing. The world of automobile is changing to electric vehicles. But why this fluctuation? These are all driven by emotions, and that's where you have to control it, guys. So you have to buy Tesla at 110. You have to buy Tesla now at 240, because as many of the analysts have been forecasting, Tesla by 2027 will be 2,000. And that's not me talking about it. I will quote Cathie Woods of ARK Investment. You can go and Google Cathie Wood of the ARK Investment and you can see a lot of her videos and interviews. Not only that, Barron, who runs family business like $1 trillion business, he thinks Tesla will be $1,500 in 3 to 5 years time, pretty much the same time frame, 2027. So now is the time to buy. I'll come a little bit later to talk about it, how you value the company. It's very difficult to value the company, guys. So anyway, the third principle is buy wonderful businesses at fair price and not fair businesses at wonderful price. And here Warren talks about used cigar butts, which he learned, the value investing he learned from his teacher or the guru, Graham, who has actually written the book, The Intelligent Investor, Benjamin Graham. And guys, if you have not read the whole book, The Intelligent Investor, it's a pretty thick book, by the way. You should go and do that. And if you think you don't have much time to read the whole book, just read the 4th chapter, the chapter where he talks about Mr. Market. I'll discuss about Mr. Market some other day. So Warren actually learned that and developed that used cigar butt principle. So he'll actually look at the used cigars thrown in the rubbish or on the streets, wherever, the soggy, ugly looking cigar which has one puff left in it. He'll pick it up, get the puff, enjoy it and throw it. And then again look for another cigar, another soggy, ugly looking cigar for another puff. And it's kind of value investing, not that, but according to Warren Buffett, he tried that for a long time and realized that that's not the right thing to do. Yes, he mentioned in one of his interviews that that was a mistake. And that's where he changed. You can make money in that anyway. If you're buying the companies who are heavily undervalued, you can make money in that. But that may not be a wonderful business, guys. And remember, if a stock is trading at a much below valuation, there has to be a reason for that. Try to figure it out. Never think the person and the whole world is less smarter than you. And in the smarter world, never think about it. The market self-corrects. If you don't trust me, go and read The Random Walk on the Wall Street. Well, that's when Warren Buffett actually understood that used cigar butt methodology is not the right thing to do. You can make money, but you cannot make big money out of that. And that's where actually he met Charlie Munger, and who had a little bit different principle for the growth companies who are growing. And that's where he came out with this principle: buy wonderful businesses at fair price and not fair businesses at wonderful price. Well, another one which is a well-known fact for everybody is buy only stocks or the businesses you understand. Yes, don't just buy because somebody is recommending that. You don't have much idea. Everybody is talking about the AI boom, generative AI, artificial intelligence. Everybody is talking about that. Do you know artificial intelligence? Do you understand what the hell is that? Do you think it's really going to change the world? Do you have that conviction? If not, don't worry about it. It's not in your circle of confidence or circle of competence. Both are important. Warren talks about circle of competence. I actually added one more there, circle of confidence. If you don't have confidence in doing something, why to do? So develop the circle of competence by understanding, studying, talking to people, learning from knowledgeable people. And for that matter, you can also rely on synonomics, because I only pick those topics which are relevant, which are pretty much involved or related to the science and technology. Because finance and all those things, there are plenty of videos out there, guys. And that's why my style is like lecture style. I'm not sharing my screen and the data and all those things. Even if I have to talk about the data, the P&L and the balance sheet ratios, I actually read them and then kind of tell them in the video. Well, enough of marketing synonomics. Let's get back to that. So you should know the company you are investing in. Very, very important. Peter Lynch talks about that as well in One Up on the Wall Street. He says, buy things you have been using. You don't have to look around, you don't have to do analysis and go through all the research and listen to all these financial advisors. You do your own analysis, see what's your circle of competence. For an example, If you're a doctor, you will be in a much better position to understand the pharmaceutical companies, the hospital stocks, pharma stocks. You should be able to understand that and understand what's the future for that. If you are an engineer, you should be able to understand a lot of engineering companies, guys. If you are into IT and computer science guy, you should be understanding a lot of the new technologies that we are talking about. Large language models, artificial intelligence, generative AI, all those kind of things should be piece of cake for you, or if not, you can learn it. So you should first know the company that you're buying before you invest. And that's why I have started this series, guys. Investing without knowing Warren Buffett. Investing without understanding Warren Buffett's principle, his philosophies, and his guidelines for the stock market is just like becoming an engineer without studying mathematics, without studying mechanics, and without studying engineering drawing. Yes, it's just like becoming a doctor without knowing the human anatomy. So it's pretty simple. Only invest in stocks you know, and if you don't know, learn about it. Bring that company, bring that business, bring that industry within the circle of competence for you before you invest it. Another one is very important for life as well, and that's like seize the opportunity. And that's not only for stock market, that's for the everyday life. Life doesn't give us many opportunities. It gives selective opportunities. And that's where I have been talking about creative visualization. Do you want to see the opportunity? Do you want to create the opportunity? You should meditate. You should do creative visualization. You should do all the methods that I talked about in my previous videos. If you are new to this video, don't forget to go and see the playlist. There is a playlist for that. There is a podcast for that, Money Meditation series. And that's very, very important. The question is that, are you going to wait for the opportunity to come and understand, recognize it, or you want to create opportunities yourself by all these techniques? And once the opportunity comes, how will you recognize them, guys? And that's where the importance of intuition comes in. And that's why developing intuition is really, really important. So seize the opportunity. Big opportunities in life needs to be seized. They need to be grabbed. Don't miss them. And Warren talks about plenty of those cases where he actually left it. Fannie Mae is one of the examples. He said that he knew about the company. It was in his circle of competence. Fannie Mae, by the way, is a finance company. It's backed by the government in USA, backed by the federal government. So he knew about this company. He knew about the operations. It was within his circle of competence, and he did not buy that. And he said he kept on sucking his thumb for long and missed the opportunity. So he thinks the mistake of omission is much greater than the commission. Yes. Same thing we have to apply as well. Life gives us a lot of opportunities. You need to understand that. Quickly develop some kind of vision to recognize those opportunities and grab them, seize them. Life doesn't give opportunities most of the time. And many a times, like after 10 years, 5 years, you think, oh, that was a great opportunity for me. There was a great business opportunity. Somebody was offering me partnership, or I was getting a much better job, which I said no to. And now you're thinking, oh, the guys actually who joined that company or that profession are doing much better than me. So seize the opportunity in the life. Another one is again related to the stocks. Don't sell stocks based on the price fluctuation. what will be a better time right now when the stocks are fluctuating? I'll give again same examples of the Magnificent Seven, because that's what I have been following and I have been creating my videos on. So it's easy to relate to them as well. So look at all these Magnificent Seven. They went all the way up, now they are actually fluctuating. Nvidia went all the way to 480, now it's at 430, 40, like that. It's giving you an opportunity. It can go down to 400. It can go down to 350, guys. You never know. That's what stock market is all about. Nvidia is going to announce their quarterly earnings on, I think, in the 3rd or 4th week of August. I think 21st of August, if I'm not wrong. And if the market doesn't like that, you will see the stock dropping like a fly. But that doesn't change the fundamentals of Nvidia. Nvidia remains the market leader of GPU, the market leader of accelerated computing. So just 1 quarter of result doesn't make much difference. And those are the time for you to pick those stocks. I'll give you an example for some of you who are into Indian market. A few years back, there was some challenge, some controversy regarding Maggi. Ajinomoto was found in Maggi, and actually Nestle India had to recall all the Maggi products. And the stock price actually dropped from 7,000-8,000 to 4,000, guys. That was the time to understand for the smart investors that Maggi, just one Maggi, is not going to change the whole Nestle. That was the buying opportunity. And people who bought at that time or even later, they are laughing because Nestle is trading at around 23,000 rupees right now. Yes. And I'm talking about last 5 to 6 years time. So in 5 to 6 years time, it has gone from 4,000, 5,000 rupees to 24,000 rupees, 23,000 rupees. This is the beauty of not selling stocks or buying stocks when market gives you the right opportunity. Well, so that's the 6th principle. Don't sell based on the price fluctuations. Only sell on 2 occasions. Number 1, when you need money. Yeah, we all need money. We are not investing, we are investing money, we are multiplying money in the market, not just to leave it like that. You will need money sometimes to enjoy. If you are going to do something for the purposeful endeavor, for an example, you want to buy a house, you want to buy a nice car, your dream car, you want to go for a world tour, you need money for your kids' education, you need money for another social gatherings, etc., like marriage, etc. Do it. That's the real value, that's the real meaning of your investment returns. Monetize it. Get the returns. Sell those stocks and live your dream. That's the first opportunity where you should be selling stock. And second, and the most important one, is where the fundamentals of the company is changing. When you see that the company's direction is changing, it may or may not, which is not aligned with the company's mission or vision or where the company used to operate. Or you think this is not the right thing for the company to do, maybe you can exit. Or you have doubts on the company's management, the company's promoters. You think, what are these promoters doing? Looks like there's some goofy thing happening, guys. If there is a fundamental change in the company's direction, company's financials and company's management, you can sell it and move on. But don't sell just based on the price fluctuation. It's just like buying a house you're living in, and your neighbor comes and say, hey, you bought the house in X million dollar, I'm going to give you twice that price. Do you want to sell it? 90% of us will say, no, not really. I'm living in the house. This is my primary residence. I'm not going to sell it right now. Similarly, when you're buying a good, robust business, you are not selling it just based on the price fluctuations. On the other hand, if you have money, you have some spare cash, you should top it up, guys. Though I don't advocate and I don't believe in buying in the losing, in the dropping stock price. It's just like catching the falling knife. So even if Tesla dropped from 300 to 110, I did not buy. I added it a little bit when it was in the upswing, because you don't know whether it will stop at 110 or it will go down to 50. Well, so don't sell based on the price fluctuation. And the seventh one, which I think is the most important one, is that buy stocks below their fair valuation. Buy stocks below what they are worth. And guys, this is a little bit of a subjective topic. Many of you will think that, how should I know that what's the worth of this company? Whether the company, there are multiple parameters on that, right? The financial ratios, price earning ratio, price to book, EV to EBITDA, and you name it, free cash flow, earnings per share growth, etc., etc., etc. So how will you know? And the fact of the matter is that all these companies are operating in the different segments. You cannot generalize them. You cannot value Tesla with Ford. You cannot value Nvidia with some other company who is making computers. So you need to understand the technology, you need to understand the business, and then that's what all the one that we talked about, which Warren's previous principles were, all will apply in a holistic way in this one. To analyze the market, guys, it's very simple to analyze a bond, because the bond price will fluctuate based on the interest rate. If the interest rate goes up, the bonds will go up, the valuation will change. It's a direct correlation, but in stock it's not the case. So how would you manage that? And let me give you my own style, my own studies. Let me share that with you. I personally feel there are a few things that act on that. Number one, of course, you have to go by the fundamental analysis and or technical analysis. But technical analysis is not a real litmus test for anything. If everybody is buying it, it will show you a buy signal anyway. And if it's trading at a lifetime high, it will give you a pretty much like, blue sky. You never know what will happen. So any stock that's trading at a lifetime high, technical analysis has no answer to that. And what the analysts, the chartists have said, guys, now this stock is in the blue sky zone. It will continue to move up till it drops and creates a floor for that, a support for that. So when the stock is at the lifetime high, it's in the blue sky zone, guys. And once it drops, suppose it's at $500, and that's the lifetime high, $500, at $500, chartist will say it's in the blue sky. But if it drops from 500 to 450 and moves up again, then it has actually created a resistance at 500 and a support level for 450. So now it will start its journey back to 500 from 450, and 450 becomes the base or the support line for that stock. And as it moves from 450 to 500, 500 becomes its resistance, because it had dropped from 500 earlier. So as soon as it goes to 500, many of the chartists and the technical analysts will start selling it. But if the market forces are like that it crosses 500, guys, that we call breakout. The stock has broken out and moved into the blue sky territory again. Well, that's one way to look at it. I am a firm believer of fundamental analysis. And fundamental analysis includes multiple things. Number one is the financial analysis, the one that I always talk about, the financial ratios, the balance sheet ratios, the P&L, profit and loss statement, and the cash flow. These are the three important pillars to see the health of any company: P&L, balance sheet, and cash flow. Look at those. Number one, look at the segment it's operating. Who are the market leaders? As I said, Jeffrey Moore, who has written plenty of books on technology adoption, talks about crossing the chasm, he talks about inside the tornado, he talks about guerrilla games. Without digressing much into that, in any industry there is a gorilla, is a market leader who makes the market and the others follow. In the CPU world, it used to be Intel. AMD and other small chipset companies were kind of followers. Intel used to lead the market, fix the price, and enjoy the monopoly. Right now, in the GPU, graphic processing unit, NVIDIA is the market leader, NVIDIA is the gorilla, and all the others are actually trying to catch up. So this is how it works. So if you have to analyze a company and its worth, you have to also understand the segment it's working on, the technology it is in. And if it's a consumption company, you have to see whether this company is going to stay in the next 10, 20, 50, 100 years. For an example, if you are buying, again I'm coming to that, Nestle or any of the consumption company, fast moving good, FMCG we call it, fast moving consumer goods. I mean, this company is going to stay forever, guys, unless there is a new competitor that comes in, and these companies will kind of little bit drop but still be around. The other companies, I don't want to name them here, but something like the liquor companies, the wine companies, the cigarette companies, they are going to be there. Do you really think that there will be a world where nobody will smoke? There will be a world where nobody will drink? Guys, it's increasing. Everybody's, kind of the kids are growing up, and then the new consumption, the consumers are coming in this market. So you have to understand and analyze that. Again, you have to understand, as I mentioned in the previous one, you should know the company you are investing in. It should be within your circle of competence. And if that's there, even if the price is high, then you have to do an analysis of the future cash flow and try to understand that. And if you don't want to do all those, guys, number one is that if you believe in that company, if you believe in that business, go by your guts. And that's where all my previous videos, developing the intuition, creative visualization, meditation, all those 3C techniques of mind control, Silva mind control, all this will be very helpful to you. By using all these techniques, you can actually develop the intuition, you can develop the mindset, and you can visualize the world going forward. And once you do that, you are convinced, then you see the analysis. Are you comfortable buying a stock at this price? And the answer is yes, go for it. And that's where the conviction comes into play. Guys, as I mentioned earlier as well, you need to have the right and strong conviction. You cannot just borrow the conviction. What I think is the best for me may not be good for you. One man's meat is another man's poison. Yes, you heard that right. One man's meat is another man's poison. Go and talk to the people who are vegetarians or vegans and talk about, oh, I had a good, whatever, mutton or fish and all those. They'll say, forget it, man. Don't talk about it. I don't like that. I don't. It's not my piece of cake. But if you go and talk to somebody, hey, I like this. I went to that restaurant and their recipes were great, and the fish was great, or the mutton was good. Hey, they'll say, hey, tell me, which restaurant was that? Because he has the same idea or same taste as yours. Coming back to the point, most important thing in investing is, number one, know the company. Knowledge to understand the company, number one. Number two, courage to buy. A lot of people, as I always say, that Synonomics is for the guys for entertainment and education purposes. Entertainment for people who are sitting on the sides and watching the market going up and down. But they don't have courage. They're not buying it. They had been watching the stock at $20, $100, $200, $1,000, and later on they say, I'm repenting. I should have bought it. So courage to buy is very important. Knowledge to understand, knowledge to analyze the company, courage to buy, and the third and the most important thing is patience to hold. And guys, these three principles, which of course is a borrowed principle, It's not my personal one, but it's one of my guiding principles as well in investing. By reading so many books and understanding so many gurus, I think I have just got this extract. That knowledge to understand the company and the business, courage to buy, and patience to hold is the key to a successful investing. So with these 7 principles of Warren Buffett, the great investor, the sage of Omaha, let's little bit revise them before I close this video. So the first one was that the basis of any company, intelligence, initiative, and integrity. These form the basis of or the foundation of any successful company. These 3 things should be in the employees, in the management, the promoters, and of course the owners, CEOs. Promoters and owners are the same, by the way. Pay attention to the facts and not to the emotion. Use emotion where it's required, not in investing. Go by the facts. Third one is that buy wonderful businesses at fair price and not fair businesses at wonderful price. Remember the used cigar butt principle of Warren Buffett, the kind of value investing of Ben Graham, of Intelligent Investor, the writer of Intelligent Investor. If you have not read that book, I'll recommend that, I'll reiterate that. Look at that and go to the chapter where it talks about Mr. Market. If I'm not wrong, I think it's chapter 4. Mr. Market. Read about Mr. Market. Buy only those stocks which you understand, which is in your circle of competence, which is in the circle of confidence. How will it come in the circle of confidence once you have the competence? So still the circle of competence remains the same. Remember Fannie Mae of Warren Buffett. Warren also mentioned that he missed out big time on Google and Amazon as well, but Google he mentioned because he was paying $6 or $7 for every hit, but he didn't understand the business model. So in one of the AGM, annual general meeting, I think 2 years back, he did mention that that was a big mistake. He should have kept his eyes open and options open. So let's do that as well. Buy the businesses which we understand, which you understand, which is within your circle of competence. And once it's there, seize the opportunity, guys. Life throws opportunities very few times. All the big opportunities life gives you should be grabbed, should be seized. Otherwise, you'll repent later. I have done that as well in stocks, in my life and everything. Everybody does that. If you sit down and look at your 10 years, 15 years past, you will figure it out that a lot of opportunities came your way and you were not ready. And that's where the meditation, creative visualization, developing intuition, and all those videos that I have created is going to help you. Don't sell the stock based on the price fluctuation. Just enjoy the ride. If you don't believe in dollar cost averaging, when the stock drops, you add a little bit more, which I don't do that personally, but it's just a good way to do it, especially for the high conviction stocks. If Apple trading right now is 100, it was at 196, now it has dropped to 180. Suppose it drops to 100, would you buy? You should. I gave Tesla as example. It was trading at 110. Did you buy? You should have. But if you have a principle like mine, not to buy the stock when it's losing, not to catch the falling knife, that's also fine, guys. We all have to have our own principles. We don't need to emulate. As I mentioned again, and I'll mention again, nobody makes money on borrowed conviction. And last but not the least is buy the stocks below their fair valuation. And I have already talked about how to value the stock It had technical analysis, fundamental analysis. Fundamental analysis had its financial analysis, finance ratios. It talks about the competitive landscape, the segment the stock is working on or operating in, the technology the stock is, if it's a technology company. And the most important thing that I talked about is your own feeling, your own conviction, your own intuition, your own circle of competence and circle of confidence. With that, if you like this kind of videos, and I told I'm going to start a series on Warren's Nuggets, Buffett's Nuggets, because there are plenty of things we have to learn or we can learn from Warren Buffett. His 92 years of life is going to give us like a time-tested, immortal lessons, especially in the investing, but also in others, like managing your finances, etc., etc. So if you like this kind of content and the videos, don't forget to share, like, and subscribe. Remember, Synanomics is out there to create financial awareness so that you analyze your own companies, make your own decisions, and make money. Having said that, whatever I talk about, especially the reference of all these stocks, are my personal views. They are not recommendations. Please consult your financial advisor before making any investment decisions, guys. And remember, I've been repeatedly telling that nobody makes money on the borrowed convictions. So what I have convictions on may not be the right one for you. One man's meat is another man's poison. With that, it's a goodbye from your finance guide, your life coach, Pankaj Sinha. Bye-bye.